You are here to learn more about investing because this is part 3 of my series on stocks and bonds. Loan and own is what we learned in the intro. Part 2 covered the loan portion with bonds. So this must be the good part, where you learn about stocks, equities, blue chips, splits, day trading, IPOs, margin, shorting, going long, small caps, large caps, and everything in between. My name is Ian Goldie, and this is Finance in 5 Stocks. In my intro to this series, I spent 5 minutes explaining the difference between stocks and bonds. And this is my extended version for those thirsting for more knowledge, so you can become the best investor possible and turn your dreams into gold. If bonds are loans, and then stocks are owns. If you own shares of a company, you are a shareholder and thereby a fractional owner of a company's equity. You are a partner in the company's growth and have potential to share in that business success, but also potentially suffer the loss of some or all of your capital placed in this one investment. In most circumstances, if you invest in stocks, you can't lose more than you invested, meaning you can't lose more than 100%, unless the investor uses margin. And margin will be covered in detail for another video, but simply said, you are borrowing against what you own to buy more of it. If everything goes right, then you make more money as you're leveraging basically off your existing asset. Goes wrong, well, that's bad. More than 100% bad, maybe bankruptcy bad. So this is not about margin. This video is all about individual positions. In my video for funds, ETF or mutual, I can explain how you can invest in baskets that hold like individual positions. But for this is about individual positions. To take a brief step back, let me share my experience with business and investing. It's a unique tale that I will explain in greater detail maybe in another video. I have a type of weird relationship with math from an early age where I would count the markers on the freeway or guess how many boxes were on the shelves. So reading the weekly newspaper and business section was always interested. Sometimes I learned about all the symbols, what they meant, and around 5th grade I got a little serious with a summer school competition for stock picking. At the same time, I tried to file my first patent. I'll explain in a later video. A great deal has transpired since my early beginnings at age 10. Many startups and business ventures. A car cleaning business I started in high school. Within a few years, became the detailer to the stars. I have patents for fluid dynamics, containers, and beverage holders. I've also been a software developer. I have multiple trademarks and basically a ton of business and life experience. Now, when you make money, you need to learn how to save and invest. I did, and turned it into a career for 25 years as a professional financial advisor and portfolio manager. A portfolio manager is the person making buy and sell decisions, and then sometimes also one pushing the button to make that trade. Now, I've pushed the button on $1 million trades countless times in my career. It's an awesome, awesome responsibility that I still treat with the highest level of care and respect. It's that care and respect that I wish to extend to you guys right now with some more knowledge, so you can become your own portfolio manager, building an investment portfolio that's right for you. And hopefully, I can help you on your own journey for learning and understanding investing. I spread these financial lessons over multiple videos. So you should make sure to check out a very important video in this series called Valuations. I talk about assessing stocks, and my video also on returns. Honestly, if you're serious about becoming a great investor, you watch all the videos you can in this series. Take notes and build up your knowledge before making your first stock trade. With that said, let's dive into stocks. In the tail end of my last video on bonds, I talked about convertible bonds, which are part bond, part stock. One part of the bond collected interest payment while you waited for appreciation to hopefully occur on the equity portion of that convertible. That same theme of income and appreciation is also found in common stocks that pay dividends. Now, common stocks will be the first type of stocks I'm going to cover, and this will be followed by common stocks with dividend and then preferred stocks. And I'll briefly explain IPOs, stock splits, shorting, spin-offs, mergers and acquisitions, and some of the strategies for buying and selling stocks. So strap in, it's going to be interesting. When you're a company and you want to grow, the fuel for that growth is cash. And if you don't borrow through a loan, then you sell parts of your business to people who believe in your company and its leadership. Those believers become shareholders in the form of stock ownership, depending on how much they purchase relative to how many shares have been issued. The business cycle of loan and own is in full function when we are shareholders. Financial jargon, bullet point. Stocks are referred to as equities or securities. If a stock has no place where active traders are buying and selling, then that stock is called a liquid. It's trading in an illiquid market. It's the liquidity and ability to buy and sell in an orderly fashion that makes a market. So what started out as a way for Dutch investors to fund voyages moved across the Atlantic to a buttonwood tree in New York, where the first stock traders shared their own marketplace. And those first 24 traders formed the genesis of what's now the New York Stock Exchange. NASDAQ and other exchanges also followed. NASDAQ alone traded NASDAQ traded $221 billion on an October day in 2020. Single day. The stock markets are a huge part of everybody's lives in where capitalism is available. Even those who think that it doesn't affect them because they don't own stocks might have their pension or future income stream based on stocks. Stocks or equities are a very, very big deal. Common stock. Why use common? Is there another type? Well, yes. Yes, there are. And they'll call preferred. Sounds very late. Preferred. Well, it must be better, not better. No, not better. Different. How different? In business, there exists an order of a company's structure, and this order is used for the financial balance sheet to explain the equity and debt of a company. It matters for ratings and other things. This order also exists in case a company fails and must be liquidated under the U.S. bankruptcy court system. Here is the chart. And you see from this ranking, if a company needs to liquidate, the very last people paid are common stockholders. Above them is preferred. I told you they were special. But not as special as bonds, as they get paid before all stocks in case of liquidation. And if there's any money left over after the top group has been paid, then those remaining funds trickle down to the next left in the list, and so forth and so on. And this is the reason why people seldom receive any cash of significance for their stock, common stock, in the event of a bankruptcy. Common stock is what most people own and what is quoted on the TV, online, and outlets. In the UK and some other countries, they call it, refer to it as equity shares. I'm not going to do my accent for this one. It was bad enough before. Sorry. Sorry, Britain. Here is a Yahoo Finance snapshot of a stock, and I will review all the information so you could better understand. Yahoo's not a sponsor of this video, but I do think they have some excellent tools for many investors. Lots of financial jargon coming up. Are you ready? All right, let's dive into some details. These items are going to come at you rapid fire. Don't expect you to retain and remember everything in one viewing. Plan on going back and reviewing at your own pace and using this video as a reference material. Previous close was the last trade before this trading day started. Open is the price of the first trade in the session, as some stocks might be trading before the market opens if there's good or bad news. Bid is the price that you receive when you're selling, and ask is the price you receive when you're buying. The number in between these two is called the spread, and I use the 52-week range to get a sense of where stock is trading today relative to the last year. Is it on the high side or the low side of the 52-week number? Growth style investors might buy companies that are trading at new highs, and value style investors might be trading in stocks that are only trading near their lows. Average volume is very important because a higher number shows that the market has plenty of buyers and sellers, which makes for an efficient market, good liquidity. And low volume can translate into erratic behavior between the buy and the ask. So for larger investors by dollar size, you might not be able to buy or sell at the shares you want. That is in a timely manner. It can take days or weeks to build or unload a position if it's a small position, thinly traded. Next up is market cap, which is short for capitalization, and this is a quick method to determine how big the company is from the formula of shares issued multiplied by its current share price. That's capitalization. So a company with 100 million shares issued and trading at $10, that's $1 billion market cap. This cap number also puts companies into a category for size. The super big companies are called mega caps, and their number is typically over $200 billion worth of value, Large caps over 10 billion, mid caps over 2 billion, small caps over $300 million. Micro caps are the ones below $300 million. Now, Amazon, they didn't start out as a mega cap, and some of the greatest investors of all times have gained fame and riches by discovering and investing in companies while they were smaller and capitalizing and watching the companies grow while holding on to their initial position. That's hard to do. One of the great investor stories of our time is Ron Barrett. Great investor. He started out with small cap money manager. And if you like the Tesla stock story, you should follow Mr. Barron, as he was an early investor and his insight is worth your attention. Even if you don't like Tesla, it's important to see how a smart mind works. Follow Ron Barron. Moving down from market cap is beta. And I discussed that in a prior video called Risk and Return. Beta is a statistical, say that 5 times fast. Beta is a statistical way to measure volatility over some type of benchmark. In this case, the benchmark is the S&P 500, and a beta over 1 indicates it's more volatile than the S&P 500. PE ratio, price earnings ratio, is one of the most used and most misunderstood numbers for investors, especially when looking at a quote like this on Yahoo Finance. The P, the price, and the E is the earnings per share. You divide the P by the E to equal PE ratio. So, $10 stock with $1 in earnings has a 10 PE. Who uses this number? Why should you care? And what do I pay attention to when making $1 million decisions? Look, the PE number is often quoted online based on trailing information, and I'm interested in buying based on the future potential. Because a company might have a big tax write-off or some temporary blip, which causes their recent earnings to be affected. So this requires digging and doing your work before buying. A company has steady earnings. Look at the trailing PE gives me a sense of historically what that company has been valued at within the marketplace. Example, energy and utility stocks are often associated with a trading PE range of 6 to 12. Bank stocks are very similar. What I look for is forward earnings for stocks that have potential to meet earnings estimates and still be trading at a bargain PE ratio, maybe relative to the S&P 500 or their peer group. For example, if you have 8 bank stocks all trading for around 10 times earnings, forward earnings, and then you find one bank stock you like trading for 6 times for future earnings, then that stock might be a value bargain relative to others. PE ratio is just one tool, one indicator. There are more covered in my video on valuations. Forward yield is one of my prime indicators as I manage money for many retired people, and reliable dividends are a backbone for income and retirement financial security. Yield is the formula for stock price divided by the dividend. A stock selling for $10 that pays $1 in yearly dividends has a yield of 10. That would be very high. There are other tabs at the top for charts, statistics, and other information. I will cover in an advanced form of stock analysis in another video. Until that video, I do want to glance at just a few items on the statistics, particularly the PEG ratio, PEG, and enterprise value, or EV.
Hey Finance in 5 viewers, it's Adam Myers back in the office for 2 quick tips for analyzing stocks. Both of these are covered in our video for valuations. First is the PEG ratio, which represents the price to earnings growth ratio. A PEG ratio more than 1 means the stock is growing faster than earnings. That's a good sign. Your second tip is enterprise value, or EV. In my opinion, EV is a great, quick way of understanding a company's worth because this ratio factors in a company's short and long-term debt plus cash on the balance sheet. The EV ratio is also known as the takeout price someone would have to pay if they wanted to buy the company. It's not 100% accurate, but it's a quick approximation to let me know the range of a company's selling price in liquidation or buyout. What isn't on the balance sheet is the intangibles and unknowns they can radically alter a company's value. One example of skewing would be a cigarette company that was facing a lawsuit. The outcome, when intangibles are factored in, could be billions of dollars because they're part of current balance sheet for debt. But the possibility of losing had to be factored into the value I might be willing to pay today for a stock that might be negatively affected tomorrow. So EV value with a twist. Back to you, Ian.
I explained yield as a function of dividing share price by dividends. And stocks that pay dividends are either common or preferred or convertible. A common stock that pays a dividend is because the board of directors deemed it a good strategy to share profits with their shareholders in the form of a quarterly dividend. Companies don't have to pay dividends. There is no regulation that states they do or how much, unless you are a REIT, real estate investment trust. A REIT, to maintain their tax and legal structure, a REIT must pay out at least 90% of its net income. What do I look for in buying dividend-paying stocks? First is a fundamental business, because if you try and chase yield with dying businesses, then you're going to lose money as the stock declines reflects the poor business model. Second is a dividend consistency, and does the company have a history of keeping or better yet raising their dividends? Dividend aristocrats is a financial term assigned to companies that have a historical pattern of raising those dividends. And you can buy a basket of them, these types of companies, in an ETF symbol NOBL, Noble, distributed by ProShares. There's other ones. I'm not currently sponsored or compensated for this recommendation. Third, and you probably have to look at a prospectus and all that other legal stuff. Third, I look for a company that has dividend coverage. Another financial term, dividend coverage. Simplified, this represents how much of the dividend is being covered by current or future earnings. A bad sign is a company that is paying out a dividend that exceeds their profits, as this cannot be sustained long term. Secondarily, a dividend too close to the earnings is equally treacherous. For example, using GoTo-Financial, IBM has a current 73.6% payout ratio. A lower payout ratio is really what you want to look for, as it indicates the company has little difficulty in paying their dividend from profits. IBM on October 27, 2020, declared their dividend, which is the business way of saying they're distributing a payout. And according to IBM, they have paid a consecutive quarterly dividend, ready for this? Consecutively since 1916. That's 100 years of consistency. Say what you want about IBM, that's a nice dividend. The fourth thing I look for in a dividend stock is how much is the dividend paying relative to the current 10-year U.S. Treasury bond. Now, a yield close to the U.S. Treasury is less appealing than a high yielding with greater return potential. The difference between two financial points is called the spread. This higher spread helps buffer the risk involved in owning stocks. Any stock is a variable purchase, and along with this comes more risk of default than, let's say, a U.S. Treasury. They're not even close to as safe as Treasuries. You need to be compensated for the risk, and this yield spread is one way to determine that opportunity for risk reward. Fifth, in my dividend assessment, is some fundamental review of the stock being considered and management. Why? Because as I mentioned prior, the board of directors decides how much, if anything, will be distributed to shareholders in the form of dividends. During COVID crisis, many great companies simply said that their market is uncertain. We should save every dollar. So they suspended dividends. One day you were going to get a dividend check, then the next day, not. Companies don't need to pay you back for missed or altered payments for common stock, but they do have to make up for that missing dividends on some preferred stock, which will be covered soon, cumulative preferreds. What I look for in management is the possibility that the CEO and leadership might decide to fund growth initiatives from their free positive cash flow and say it's better use of funds to grow versus distribute profits in the form of dividends. I recently went through this very exercise in my portfolio purchase of AT&T, and of this writing, the dividend has remained steady, but I'm not entirely confident that it will remain this way forever. Preferred stock, the snooty version of a stock that is better than the common. Not going to do the accent again. Not better, different. Not all companies issue preferred stock. In fact, most do not. The majority of preferred stock is issued by banks and other financial companies. The reason is very simple. It's how the equity of preferred shows up on their balance sheet and how their balance sheet is examined by banking regulations. By issuing preferred stock, companies are raising capital without issuing debt. Examples include secured and unsecured bonds. Preferred stocks can suspend their dividends, but most of the ones I purchase have a feature called cumulative preferred. And this means the company must pay you back for any dividend they might have missed in the past. If it's non-cumulative, they do not have to pay back missing dividends. Preferred stocks trades on a much lower volume than the common stock counterpart, so liquidity is sometimes a concern. Plus, there's often a larger spread between the bid and ask price. Think of a higher spread as a tax on lower liquidity. Preferred is typically purchased for buy and hold consumers or specialty money managers with a focus on income and yield. One huge consideration for preferred, often overlooked or misunderstood, is the ability for the issuing company to call back the preferred at a specified price and time. And the other component of possible no maturity date, known as perpetual preferred. So a bank issuing a preferred can call back the stock when the price is good for them to redeem. Yes, got it. Call. But when it's not, the preferred can go on forever? Exactly. No maturity date. You can lose that preferred at a time when you might want to hold on to it for as long as possible. Example, rates go down and you have a high paying preferred that you want to keep. It pays great yield relative to the new lower rates of the day. Bank says we want that back, and no matter what you paid for the stock, we are buying it back for $25 a share. Wait, I paid $27 a share. Too bad. Wait, it's paying an 8% yield. I want to keep it. Too bad. Stocks are a deep discussion, so I'll add new videos for specialty analysis and strategies, but let me conclude this video by explaining IPOs, or initial public offerings, stock splits, blue chips, and day trading. When a company wants to raise equity for the first time, they find a stock exchange or sell directly to the public in a direct offering. Either way, this is an initial public offering, an IPO. And hot IPOs are typically consumer-oriented, stocks with high public awareness and in demand, where the first trades in the market might exceed the initial price of the IPO. Bankers, together with the company executives, agree to offer an IPO price. For example, let's say $15 per share. They are going to offer 10 million shares for sale. But at this time, they might only release 8 million and 2 million are held back for a later date or used for another purpose, such as stock grants for employees or other purposes. So one morning, the executives gather around with their friends and loved ones and ring the bell of the exchange, where their stock will be traded. Those 8 million shares begin trading, but sometimes they don't, because the desire by some to purchase is so great that the price to buy is being driven up before that first trade has ever even taken place. What was supposed to sell for $15 is quickly rising to 18, then 20, then 25. This is known as a hot IPO investment, hot IPO. Most of these are due to consumer awareness of the stock being issued and the demand or hunch to believe in the company long-term and get on the initial first trades. Be careful of getting swept up in the euphoria of a hot IPO, because this has historically been a very volatile purchase. One strategy might be to wait some time and monitor, and I will often track to see if that stock violates the floor of its IPO, meaning they go below. If they do, I'll sometimes consider their purchase. That's now maybe a value. Buying as the stock that is racing higher is known as momentum investing. Now, absent of financial and fundamentals driven by desire and belief and speed of the stock appreciation for bullish investors, or depression for bearish investors. Bulls charge forward, bears strongly retreat. Stock splits can be complicated, so let's make it simple. As simple as pie. If I have a delicious pie and everybody wants a piece, I can make it more accessible by cutting the pie into smaller pieces. By cutting the pie up, I don't make it bigger in total, just more fractions and pieces. The advantage is companies make their stock prices lower, so consumers feel it's more attractive. Professionals don't care how much a share price is because we only focus on total return potential. In fact, many companies hate splitting or refuse to split their stock because it just creates more short-term shareholders, more paperwork for legal, more costs, more headaches, less shares, and fewer shareholders that buy and hold is what is desired by management. Americo, better known as U-Haul, has refused to split their stock as a company. Management has stated their focus is finding long-term investors. Warren Buffett and Berkshire Hathaway resisted splitting their stock forever. But it got so high, they even had to eventually create the baby B share, which represents a fraction of the A share. The A share is $321,000 a share, and the B is $214 at this time. Pro tip: I never buy or sell anything based on the news of a stock split. It has nothing to do with fundamentals for their profitability and prospects as an investment. Blue chip is a financial term assigned to big companies that were once considered stalwarts of an industry and too big or strong to fail. GE and IBM are good examples of blue chips. In my opinion, in the year 2020, there is no use for terms like blue chips because the financial landscape changes so quickly. What once was strong and mighty can quickly look weak and shaky. So I want to conclude this episode of Investing in Stocks with some brief thoughts on day trading phenomenon, because with 25 years plus as a financial advisor and portfolio manager, man, I've witnessed a great deal of traders. When I started my career, we used to use a vacuum air tubes to route orders to the cage when they're hand typed into a system. So I know I'm sounding archaic. I'm just trying to say I have a lot of experience with people who've traded. No matter how far I go back with technology, greed has always been a component of stock investing. Electronic execution and the speed of the internet trades has only amplified the greed factor. Combine that with videos of how to get rich quick, or other people spouting out their strategies for instant riches, and you get an industry for day trading. I've watched many interviews where day traders call buy and hold investors suckers. I wonder why the Forbes list of richest people are filled with buy and hold investors, but I've never viewed a single day trader that has made the list 2 years in a row. I'm not going to tell my viewers to not day trade, but I am hopeful that the lessons you learn from my videos will make you a better long-term investor. If my desire is to help you turn your dreams into goals, then day trading will not be the anchor you use to help you achieve your ambition. Invest in yourself by helping us make more videos. Hit the like and subscribe. Hit the like and subscribe. Hit the like and subscribe and notification button. It's the easiest return on investment we might ever get. In the comment section, tell us what you like or how we can improve. I'm Ian Goldie. This has been Finance in 5 Extended Edition, Stocks and Bonds. Stocks! I have other ways to learn about financial topics in our series, so please check them out and share with family that you want to see become financially successful. Here is our summary of what was learned in this video.